Right now, we've got Anton Schutz. He is the founder and the president of Menden Capital Advisors, managing about $170 million of financial stocks, including Citigroup and Travelers in the portfolios, managing the Burnham Financial Industries Fund. It's outperformed 98% of its peers over the past 12 months. A very impressive return, especially for a fund that invests in financials, up more than, as well, 17%. Right, Anton? That's
right.
Great. Congratulations, and great to have you with us. Okay. Earnings, big bank earnings, brokerage earnings, Goldman Sachs, are they all going to beat expectations, do you think?
Well, expectations are certainly pretty high for names like Goldman. Everybody's been revising the estimates upwards.
Imagine how that happens. Just before the earnings come out, everyone says, well, maybe they're going to do really well.
And, you know, Goldman has a history of beating those numbers. So I think Goldman's certainly going to probably post a very, very strong number. I mean, what a great quarter it's been for underwriting both bonds and equities, particularly financials. And Goldman and J.P. Morgan and Bank of America and Morgan Stanley have really had a lion's share of those deals.
Well, particularly because there are not that many players left, right? You don't have Lehman this year. You don't have Bear Stearns, so you got two.
And guess what? If you're a TARP bank, you're giving a TARP bank the underwriting assignment. That's the way it's happening.
Well, explain that. What do you mean?
Well, you know, you don't see Deutsche or UBS or Credit Suisse on a lot of the financial deals. And, you know, they've been backseat on a bunch of them, but I think they're kind of taking care of each other, keeping it domestic right now.
Home team, so to speak.
Home team, yeah.
All right, so what happens if earnings, let's say, exceed the expectations? Let's say Wall Street, all those analysts get to keep their jobs. What happens to the stocks, do you think?
Well, that's a good question. I mean, you look at the performance. I mean, Goldman's certainly had a pretty good run, you know, over the last couple of months. We've seen some upside. I think Merrill upped the target on them to 175 the other day. So, you know, I think Goldman could certainly continue to have some legs to it. I don't own it at this point in time, but I'm watching it and hoping I'll get an opportunity on a pullback. I think the banks are more of a wild card because there's so many moving pieces here. You know, you've got TARP repayment, you've got FDIC special fees, you've got asset sales. Citi sold a whole bunch of businesses. So I think you're going to see a lot of numbers on the surface. You're going to have analysts digging down beneath.
So, well, that's my point. In other words, you're going to get that headline number. Right. Everyone's going to be worried about, you know, the red sticky. What's it going to come across the Bloomberg? Are people going to turn to page 6 and go into the footnotes and really care?
They're going to have to. They're going to have to. I mean, you know, Citi, for example, is probably on the headline going to post a really strong headline number. You know, they're going to have all sorts of asset sales and gains in there. And certainly securities on the balance sheet acted much better this quarter, too, maybe some write-ups. So I think Citi on the headline number will be very strong. Then it'll be drilling down into the credit and the rest of it, and, you know, that won't appear quite as strong. All right, I do own Citi.
Okay, all right. Well, let's talk about some of that credit that exists on these bank balance sheets.
Sure.
I mean, let's start with whole loans, for example.
Right.
We've been talking this week. I had Daniel Alpert of Westwood Capital. We talked to Dick Beauvais of Rockdale Securities, and we've been looking at this issue of what about those whole loans? Are they going to get marked down, or are we just going to change the terms so that they look okay?
Well, you know, they're certainly, you know, trying to work with the borrowers, but, you know, they've been building reserves for many quarters now. I mean, Citi went into this, I think, with a reserve ratio of 1.27. Forgive me if I'm off a few other basis points. They're up over 5% now in reserves alone. So they're, you know, they're building a war chest. Plus, you have a ring fence around a lot of bad assets as well from the government. So the true loan to loss ratio, is actually reserves, is quite strong.
All right, so as an expert who knows about banks, you're going to wait till the earnings season goes by to actually buy or sell? You're going to wait and see what happens?
Well, certainly you've got some positioning ahead of this. I mean, you know, you know, the strongest of all of them is J.P. Morgan. Again, there'll be a lot of noise there because of repayments, but they ought to have a terrific quarter in 2 business lines. I mean, certainly the investment bank is really rocking, and there's no doubt about it that the mortgage business is going to do great for all the big players in the business as well. So those 2 line items are going to be terrific. People are going to be questioning sustainability. I think the conference call is going to be very important. Can they print those same kind of mortgage numbers? You know, is the underwriting going to be the same? All
right, we're going to continue the conversation more with Anton Schutz of Menden Capital Advisors. We're going to take a look at something called business development corporations, what they do and why you might want to invest in them.
I think that the largest shareholder, namely the government, has decided that they really do need to see some changes. I think you're actually reorienting the company towards international growth. I think that there is some real concern here about some of the domestic. And frankly, I'm curious as to what it means for the quality of earnings that we see this quarter.
That was Josh Rosner of Graham Fisher questioning what we may see from Citigroup's earnings coming up in the next quarter. Now, Let's find out what our guest thinks. Anton Schutz, founder and president of Menden Capital Advisors. Before we get to Business Development Corporation, just a last comment or a question really on Citigroup. We were talking about how Citigroup seems to just have nothing going right for it. Can these guys catch a break?
I really wish they would catch a break. I mean, they've certainly done a lot of the right things under this new management team in terms of, they've sold 22 businesses. They've shrunk the balance sheet by $500 billion.
They brought in a whole new management team this week.
People. Yeah, well, they certainly added one Gene McQuaid, who I love. I mean, Gene's a straight shooter and great respect on the street. I mean, he was a senior guy at Fleet, and Bank of America bought him, became a senior guy there. Then Merrill picked him up, so he's even been at Freddie Mac. So he's been around.
So a lot of credibility.
A lot of credibility. Senior guy, well respected by the street. Look, the street likes Ned Kelly, who just got moved from CFO to vice chairman, but we like him too. Those are good people. The street trusts those people.
Do they want to see the government out of Citi? Is that the big deal?
We'd like to see the government out of a lot of things, but look, you have to give the government a lot of credit. And I saw some grading today of some officials, and yes, I will give Bernanke an A+. He's missed some things, but boy, we wouldn't be in any condition today if he didn't, come up with some massive plans. So he's done a great job. Geithner got out of the gate slow, but he's getting it. I wish Sheila Bair would stop messing with management at Citi and other companies. I mean.
All right, well, let's talk about one area of the financial world that, at least so far, they have their own problems, but they're dealing with them without the help of the government, at least it seems right now. Right. This is the world of business development corporations. First of all, what are they? And there are some rules governing, like, how you run a business development corporation.
Absolutely. Yeah. I mean, these are entities that are almost quasi-banks. They're typically not very levered, but they tend to lend sort of at a lower tier level, more, subordinated or mezzanine type of debt. And, these companies were fast growers and paid out big dividends, but they don't really build loan loss reserves. They really take the hit in the market. And unfortunately, what got a lot of these companies into trouble was they chased the leveraged loan market. And spreads were too tight and things were too risky. And now it's unraveling. And that unraveling is creating an opportunity for those that didn't chase that market.
All right. So do you own some? Or do you,
I own one.
Which ones do you own?
I own PSEC, Prospect Energy. And what makes them interesting is not only do they have some pretty interesting energy properties, they actually have raised capital a number of times this year to take advantage of others' distress. Because it looks like they're going to try to buy some portfolios from some of these others whose banks are pounding on their door going, pay us back now. So they'll be able to buy some great loan portfolios at big discounts. So, that's where the opportunity lies today in buying distressed securities.
How difficult is it to pry these loans away from bank balance sheets?
Well, those loans aren't on bank balance sheets. They're on other BDC balance sheets.
Oh, okay. All right. So other distressed BDCs
are
suffering.
Yeah, the bank's trying to get paid back. So they're saying, hey, de-lever now. You're in violation of your covenants, and so these guys are going to be selling stuff at fire sale prices.
And this is why you want to be buying the stock of, let's say, like a PSEC right now.
Absolutely.
What about the payouts from business development corporations?
They have to pay out a very high percentage of what they earn. They're almost like a REIT structure. So, given that those large payouts, the dividend yield is very, very attractive. I mean, they pay out about $1.60 a year in dividends on a $8 to $9 stock. I mean, wow, pretty attractive.
What about the specialty finance companies? Because I noticed in one of the funds, Chimera, right, that Chimera Investments, CIM, that's one of your biggest holdings.
It is.
What do you like about specialty finance in an era where there doesn't seem to be a lot of finance going on?
Well, they're really a mortgage REIT, and they specialize very much so in buying some of these distressed securities. Again, the opportunity here is phenomenal to buy these securities, from banks, from hedge funds, from others, distressed sellers that have brought prices down. They benefit if prepayment speeds pick up. And certainly the administration's trying to make that happen. They benefit if rational pricing returns eventually. PPIP will be an eventual help to this. I mean, everybody's rushing to raise capital. So those companies that already have raised the capital and deployed it are really sitting in the catbird seat. So a name like Chimera, a name like Redwood Trust, which I also own, are interesting. And met with an interesting company today, CLA, which is a SPAC, converting to a mortgage REIT.
Just tell everyone, what's a SPAC? A special purpose vehicle?
It's a special purpose vehicle. They're supposed to go buy something. They didn't. Their time is kind of running out. And they got approached to try to create a new vehicle. And so you can buy this thing at book value. Eventually, if the shareholders vote to change this thing, you can buy something at a big discount to the space, and the management team they're bringing in has a terrific track record. So I think that's where the opportunities are going to lie in buying some of these distressed securities out there, and I think some dividends will be created. They'll be nice, but I think the capital gains could be pretty impressive eventually as well.
All right, before you go, I want to get your thought, though, on something a little bit more plain vanilla. This is People's United Financial.
Absolutely.
We know that from when it used to be People Bank of Connecticut, right? What's the story there? Still like it?
Still like People's. You know, I think what happened with People's, I mean, it's certainly one of the best performing financials over the last year, but more recently, people have wanted to take on more risk. And so those that were hiding in People's have sold it and put some pressure on it. But People's is in great shape. They got way too much capital, and we're all waiting for them to do a deal.
Right. They were going to go buy something.
Well, they're still looking, but they want to pay the right price. So I give them credit for being patient. I don't know if they missed the bottom or not, but there's some pretty broken companies out there that could use a lot of capital. So I have faith in the management team there. I think they'll find some good properties, and I think they'll create some value for the shareholders. So yeah, it's still a pretty big position.
All right. I want to thank you very much, Anton Schutz, coming in from Menden Capital, sharing your thoughts about business development corporations as well as the big bank earnings that we're going to see next week. Thanks very much for coming in, sharing your insight and expertise.
Pleasure to be with you.